Hey everyone, it's Ed Kime from Quantcha, and we are back for another day of the Quantcha Challenge. As always, we want you to take a look at our unlimited commission-free stock and option offer at $99 a month, where you get all of our web tools plus commission-free trading for all your stock and option trades. Uh, we've got some interesting feedback from the past few days, and I've actually spent a bit of time kind of going over it and figuring out the best way to approach this. One of the things that came in was the discussion of Greeks. I kind of have been flying around, just really glossing over the core thing of what Greeks are. And I know there's a lot of investors out there, a lot of folks who are watching this on demand, and they're asking for a little bit more context on the Greeks. And I know that there's a bunch of content out there. We have some videos that incorporate discussion of Greeks. I definitely recommend, even just going out and using Google to find some stuff. And of course, the Option Industry Council has a lot of stuff, and there's a bunch of great YouTube videos and other sites. And I recommend just checking out all the content you can to understand Greeks really well before you start investing, and then especially to kind of keep primed as you continue to invest. I'm going to do a kind of a crash course over a couple days just to give some basic context so the trading we do makes a little more sense. I hadn't really considered that ahead of time, but if you have questions, please continue to either post them, especially as comments to the on-demand version of the video if you watch this afterwards, because we do look at those regularly, get on them as fast as we can, and of course we will try to incorporate anything we can into the webcast or even future training videos we have. But to dive in a little bit here, let me get to the first slide we set up here, which is just talking about option Greeks. And when we talk about Greeks, we're talking about the measurements that are measures of the sensitivity of an option, really of its price, to the parameters used to price the option itself. This is especially important because you want to know, like, hey, if any of these parameters change, which is what we care about as options investors, is we're looking at the current state of the market or of an underlying and saying we expect this to change in this way. And if we think the pricing is not exact or is wrong for the expectations we have, then we use that as an opportunity to trade the option in order to get the benefit from us being right when the general market is doesn't have the same view. Now, the parameters that are used, and this is a summary. This is not extensive for option pricing. This is, for example, going into Black-Scholes, is you have the days until expiration for the option. That's the obvious one. Like, how long do I have this option for? The next one is the moneyness of the option, which is measured as it's really saying how is the strike price of the option relative to the underlying's forward price. And I won't get into much detail on the forward price, but a good example of a forward price is if you have a stock that's paying a dividend. Let's say it's paying a $10 dividend that's half of its value next week, and the option is for 5 weeks out. Well, you're not going to use the current price of the stock as your current price for the stock. For that option that's 5 weeks out, you want to extract that dividend and make any adjustment for the value of the cash of that dividend before you price in what the option is going to be worth. But the bottom line is that most of the time you can look at the current price of the option and then plus the risk-free interest rate to determine where the stock is considered to be fairly priced for a forward date. But again, days until expiration, and then moneyness. The third one is implied volatility, which is a tiny misnomer here. It's actually the expected volatility of the stock, and then the implied volatility is what you would extract later on if you were trying to figure out what expected volatility somebody plugged in order to calculate their option pricing. But we'll just use implied volatility here to keep it simple. This is something a lot of options investors are already very well familiar with. And then the risk-free interest rate, which is becoming more of a factor now that we have one. It used to be below one, and then now it's becoming more substantial and does impact the prices of calls and puts in a meaningful way. It has enough of an impact. Now, stepping aside from those for a second, and I didn't mention things like dividends, although dividends do factor in just in the forward price. But stepping away from the high level view, the main reason you care about the option Greeks is that you want to be able to take your current position at any time and understand, like, if you buy this option and you sell that option, what should you expect from a move in the underlying? And it's really easy to do that because each of these things is relative to the specific stock itself for a given option. So you can just add up multiple positions to calculate your net Greeks. So if you have one option that's giving you 150 of a, let's say, delta, and another option that's giving you negative 75 delta, between those two positions, you're positive 75 delta because you can take that negative 75 away from the positive 150 and you get that net position. And there's ways to roll that up using beta for your entire portfolio relative to whatever beta is calculated against, like the S&P. So now that's the overview for option Greeks. And I know this is not extensive. So if you have questions about the overview, of course, let me know. The second thing is the major option Greeks that we look at and most options investors look at, which are, you'll see a lot, for example, delta. This is calculated by looking at the current circumstances that you're using to price an option and then saying what happens if there was a $1 change in the underlying price. And usually you calculate it going up a dollar or you calculate below 50 cents and above 50 cents. But you take all your pricing parameters and you just plug them back into the option pricing formula, except you change the underlying price. And that tells you that, for example, if delta comes out to be 0.50, then that's saying that if the underlying goes up $1, then the value of that option should increase by 50 cents. Now, as you'd expect, for calls, this is going to be positive. A rise in the underlying will increase the value of your call. However, for puts, not surprisingly, that value should be negative. So in the event that the underlying goes up a dollar, then your option as a put should be worth less whatever the delta is. In this case, it might be minus 50. And of course, it works the same when you flip it. So if you're short that call, then you'll take the hit for whatever the delta is for that $1 change in the underlying. And it's important to remember these are point in time measurements. So this is this exact moment. If we just repriced it with that one new parameter, what you'd get. So if you go from day to day, other things are changing. Now, delta is so important because the underlying price is really that major sticking point for pricing out options, that gamma is used a lot, which is the same measurement saying we're going to reprice the options using that change in the underlying of $1. Only instead of telling us what the change is expected in the price of the option, that's telling us what the change is expected in delta. So, for example, the gamma might be 0.10. So if it's 0.10, then that means that if the underlying price were to go up by a dollar, you should expect delta to go up by 10 cents. And this is important because a lot of times people get so focused in on delta and theta that they don't realize that they're kind of zeroing in on this perfect price point, and they might happen to be at that price point. But if they move up or down a little bit, it's going to throw delta out of whack, and all of a sudden they're going to have much more risk than they might have realized. So it's good to keep an eye on delta and gamma to understand what it is. So if you have positive delta on a stock, then that means that you're expecting it to move up, and you're being bullish on the stock. If your gamma, though, for some reason is negative, then you need to understand that with that positive delta, it's going to be decreasing as your gamma increases. I'm sorry, as the underlying increases, because gamma is going to be pulling delta down. And again, I know this might be a bit complex, so I'll try to point it out today when we talk through the portfolio and our current positions. The next Greek that's really important is theta. Theta tells you what the option will be priced at, or what the difference in option pricing is if we were just one day closer to expiration. This is kind of the thing that you look at, especially if you sell a lot of options. If you're big on credit spreads, then you care about theta because that's telling you how much money you're going to make and how quickly as time goes on. Of course, as time goes on, the other parameters change as well, so it's one of those things to think about. For theta, if you buy an option, whether it's a call or a put, you're going to be losing value on theta on a daily basis because that time remaining is going to be decreasing constantly. But hopefully you make money on something else like delta. On the other hand, if you are selling options, as we talked about, calls or puts, then that negative option position will give you a positive theta. It means that your portfolio gains over time, or your book gains over time, because time passes, assuming you've accounted for the other things. The next one is Vega. Vega is a 100 basis points rise in the implied volatility. I use basis points here just to make it a little easier to understand. That means 1%. So if implied volatility is at 40% and it goes to, let's say, 41%. Or if it were, you would price it as though it were 41% to see what would be the difference based on that 100 basis points rise. We say basis points instead of percent because if we say 1% rise, then it gets confusing as to whether you're saying, are we going from 40 to 41 or going to 40.40 as that next point? In this case, it's the basis points. And if you are someone, for example, you want to get short volatility, you think that right now it's really hectic, but you think it's going to cool off in the next few weeks, you look to get into positions where you could get a negative Vega, which means that as the volatility goes down, your price, the value of your holdings would go up. And that's again, if you think volatility is going to rise, then you go long Vega. And there's instruments like the VIX and VXX as an ETF that you can get into if you just want general exposure by buying or selling something to get that kind of exposure for the S&P. The last one is ROE, which is a 100 basis point rise in the risk-free interest rate. Now, these days we've got relatively low rates. That 100 basis point rise doesn't it doesn't happen very often. I don't know, frankly, if we ever really expect that. ROE doesn't really play much of a role, but it is still important to have there. It's good to know about. It's just kind of, well, it's probably not that useful if you're trading options on a short-term basis, within the next couple of years even. But if you're doing very large-scale trades, you can isolate ROE and you can make money on movement that you can predict based on upcoming Fed meetings and so forth. Now, getting through that, the thing I wanted to zero in on today for the portfolio was kind of talking about how that stuff applies to our book. And there were a few things I wanted to point out here. This is the positions we're in today. Now, just as a quick recap, we're bullish on Carnival. We want to see as much movement from Johnson & Johnson as we can away from 128 because we have a straddle here. We're bullish on Microsoft with a covered call, and we are bearish on Starbucks and Exxon with bearish spreads. Now, today, we're actually slightly better off than we were earlier this morning. But today, when the market opened, we were, Carnival's down. Johnson & Johnson was returning back to the 128 mark. Microsoft is up, but it's up beyond the strike price we have for our covered call, so we're really not seeing any gain from that. And then Starbucks and Exxon were both up. So this is kind of a, I don't want to say a worst case scenario, but this is a bad day for our book. And we're heavily invested in options here, but you'll notice that we're right around where we were yesterday from a total change. And there's a few reasons for that. One of the reasons for that is because even though we're trading the options, we're kind of being careful about how we're timing things. So, for example, the Carnival trade that's down a little bit, it's still pretty good for us because it is above that higher strike price that we care about. We want it to be above 52.50. That's important for us as it approaches expiration. And even though it's not down drastically, so it really hasn't impacted the option pricing too much, considering how much time is remaining. Now, if we go to the Greeks, we can see that our beta, or delta rather, for Carnival, the net delta position we have is this 37.5 right now. That means that if Carnival were to go up $1 per share, we should expect about a $37.5 increase in the value of what Carnival of our Carnival book. So it dropping 17 cents, like 1/6 of a dollar, that doesn't really hurt us too much because that means that our overall, we probably dropped about $6 in value from this Carnival book. And when you look at the distance of the spread, in this case, the spread for each of these is about 10 cents. Yeah, it's 10 cents for both of that. That's a rounding error. So we really didn't change much in value on this. So it's not too impactful for us. And that's part of the reason we want to keep track of the Greeks, is to understand how sensitive are we to the movement of the underlying price by a dollar. And then, of course, how sensitive is this delta to that? So what this position's telling us, on a per option basis, and when we do these, by the way, we're multiplying these out. When you see Greeks for an option, there's really two ways you'll see them. One is either a per share representation, and the other one is an all up multiplied by the numbers of shares controlled. So in this case, it's all shares controlled, and we have 3 contracts. Each contract represents 100 options. So in this case, we can sort of look at this negative 98 here, and if we divided this by 300, which is the number of shares we have control, we would know what our per share delta is for being long this put. So in that case, it would be like 33 cents. And so that's just kind of a thing to be aware of, is that, we've got that negative 33 cents a share. And if we ever cared about tweaking this, we might go into our book manager and look for options that better fit what we were trying to figure out here. Now, for the purposes of calculating a book, we can simply take, since all of these are relative to the same underlying, we can take all of this and just roll it up into this value, which we got, I said, about 37 and a half here. And we could do the same for gamma, for theta, vega, and rho. Now you'll notice our theta here is 1.19, which is pretty good. That simply means that we're not really hurting from the passage of time. In this case, yeah, technically we might lose $1.20 over the. I'm sorry, we would gain about $1.20 if we just had nothing else move between now and tomorrow. This would be worth that a little bit more. But the important thing about this is saying the fact that this is positive is just telling us the time's on our side for this particular trade. Sometimes you'll see, like for example, Johnson & Johnson, the book we have here is negative 40. The time's not on our side for this, and there's a few reasons for that, but most importantly is that both these positions are long. We have a long call and a long put in that straddle. So if we were to just sit back and not have any movement, we would lose about $40 a day. I do want to get into this in a second later on too, because this is a pretty important topic. But the so getting back to Carnival, so we've got that our Vega of minus of about negative $1.50. That's just because our spread is close enough where for theta, vega, and rho, there's a offset. Our shorts are offsetting our longs, and that's helping us get close to neutral here. Which means that, as you can see, our gamma and delta, these are the things that are really going to determine the profitability of the trade, and these other things are just going to kind of not be too impactful. So we're in good shape right now for this particular trade because we are where we are. Now, I'll get into I can talk about beta weighting a little bit more in depth, but the bottom line is that the formula that's done to beta weight something is simply saying if you took the current stock, its correlation with the S&P, in this case we use SPY, the ETF, the correlation between the pricing of them, also the relative value of the pricing, the ratio of them, and then you factor in the current overall delta of the stock, you're able to get this beta weighted delta. And that simply says that we've now done some math to readjust all of this along with the correlation that this stock has with the market to determine what change in value for this book we should expect as the market moves up or down a dollar. And that's important for us because, and I've mentioned this a few times, we want to be in a relatively neutral beta position so that in the event that we think that if the market just kind of floats up and down a little bit here and there, we can make money off of our directional views and off of our volatility views and all the views we have on the specific stocks. We think we could be right more often than not, and we'll make a nice tidy profit from that. However, if the market were to surge or crash, then we would be exposed to significant risk if we were hard long or hard short. So in this case, we're able to calculate this up, and since now all of these beta-weighted deltas are relative to the same underlying, all we can need to do is we can just add them up, and based on all their contributions, we get this net value at the bottom. And so, if you were really long in the market, if this is like the post-election highs and people are saying, we think it's going to go up forever, then you'd probably want to get this beta-weighted delta number as high as possible so that you could benefit from the surging market that rising tide that lifts all ships. In this case, we're kind of looking at, we don't see that. We don't see a huge up or a huge down, and we're just trying to hedge out against it. Now, I had talked a bit about the option stuff here. The other thing I wanted to call out today was our Johnson & Johnson trade. So this was a long straddle trade that was at the money that we opened up on Monday. And when we opened it up, the idea was we were going to hold on to it and hold on to it until Friday, and we'd close it the day before earnings were announced, because we wanted to try to get the benefit of any movement we might see here. So if, for example, they had really good news or really bad news or some kind of big analyst move leading into earnings, then we would see big change in the underlying. We would capitalize off that, close the position out, and make our profit. However, if it got to earnings, we don't want to play earnings here for this particular stock. So if it got to the earnings point, we would just sell it off. And then because we're in a straddle position, we would never really lose 100% of our value, but we would lose some amount of the value. And the kind of the cleverness we tried to pull into play here was that the implied volatility for this term was about 24% at the time, and we felt that as we get closer to the earnings date, which is next Tuesday, as we got closer to that date, we believed that the implied volatility at the money for Johnson & Johnson was going to rise because there'd be increased demand for those options, or people that were less willing to sell them leading into the earnings announcement. So we're kind of seeing a benefit there because, unfortunately, this here, this is almost exactly where we opened the position. I mean, if we go to our performance, we could take a look at where we were at the time. We'll take a look at the trade and drill in here, and we could see when we opened the position, the market, it was near the end of the day, it was closing at around 128 and a quarter. Right now it's 128.50. So we really haven't gotten any movement. Now, if we go back to the portfolio here for Johnson & Johnson, you'll notice we're only down less than 10%, even with the market pricing. In fact, if we were to try to close this position right now, we might only lose, let's say, $30 in the trade, which is about 7% from our original $467 investment. So if we take a look at the Greeks here, you'd see that the delta that we had, the theta we have is almost 40, which means that every day that goes by, or at least for the current day, we should be losing about $40 for our overall position because we're not seeing any movement away from the place we opened the trade at. But if we've only lost $30 after it didn't move for 2 days, how could that be? And the reason for that is because the implied volatility, I'll guarantee you right now, has gone up for the expiration. And it was about 24%. I don't know what it's at, but what we're seeing that slight little bulge in the market where, and we'll actually just go take a look at it now, where even though we're getting closer to the expiration date, what we're seeing is an implied volatility here of, for the expiration, of 25.5. Excuse me. So that 25.5 is helping us to offset because now the increased volatility for that option position is supplementing the pricing that we're holding on to, and we're not getting hurt by the theta decay like we might. Now, of course, if we were to hold through earnings and we were to not see the kind of movement we were hoping for, we would see a big crash that would return it somewhere along the lines of where it's trading here, or possibly even down to the current, the 17.7 that it has for this Friday, which has no real excitement behind it. So that's about as low as it's going to be. The long term is more closer to 18. So I just wanted to point that out because that's something that people ask a lot about, and it's definitely worthy of a full discussion as to what you expect to see in terms of implied volatility movement around earnings, as well as how you can calculate it and how you can trade it and judge against it. Now, at some point, not today, but we're going to try to capture some of the volatility rise, or rather, some of the volatility drop that occurs after that volatility crush. We'll show a couple techniques that you can get into that in order to profit from it. But a quick review of the book today. The only position I'd considered doing was that since our Greeks are showing that we're getting a little bit more negative on that beta weighted delta, I was looking to potentially get us in a position to add to our beta weighted delta position to get this closer to zero, because this negative thing means that as the market continues to move up, if it keeps going up, we're just going to see an overall drop in book value, and I don't want that. Obviously, we want to be as close to zero as we can be, and ideally benefit from the movement of the market in the same direction. Now, there's a few ways to do this. We could open a new position. We could go directly for the S&P, which we might do at some point. But for now, I think what we'll do is we'll probably work to adjust the current positions we have. One of the things you might have noticed here was we could bring ourselves almost to zero if we just closed out the Exxon position. But the Exxon position right now is a little negative, and I still feel pretty confident in our bullish view on the stock overall. And over time, I think we're probably have theta working in our favor on that trade. Actually, we're right about even on theta. But the thing we'll look at here is I think we're going to roll this call option for Microsoft. So if you recall, the plan here was we wanted to open up a covered call and use really short dated calls to finance the value of opening up the stock position. And then we're going to exit before earnings. And the earnings is on the 30th, so we have one more week of options before then. So I think what we'll probably do is, since it's at 105.50, let's take a look at what would happen if we did a roll today, because I think we're going to roll. And we could see earlier in the morning it was up here. It broke 106 for a brief period. I think that going into earnings, it's very possible it will stay above. It'll stay above that. So um, let me get rid of this. I had been experimenting earlier. I think it's very possible that it's going to go ahead and break 106 leading into earnings. So maybe what we'll do is we'll look at a way to roll the current option we have up a little bit. And there's going to be three goals we have here. One of them is going to be always to protect whatever downside we have, and in this case, that just means to stay short a call against the stock, to just soften any loss in the stock itself. Second one is we might want to capitalize on any appreciation of the value in the stock, and then the third thing is um, we want to probably try to find that strike price. If we can get the strike price as close to the closing price for next Friday as possible, that will give us the best return in value. So I'm just going to come down here. We've got the 105 call that we're holding. I'm going to click that roll button, go in here for next week. And let's say we're at 105.50. I don't know if there's other 50 cent. No, there's not. So let's go for the 106. Now what this tells us is that we'll actually collect a $24 credit to open the position. Now, this is a little bit, what's cool about this is that means two things, though, that are important. The first thing is it's $24 to open the position, which means that whatever we're buying back our current option for, we're going to sell this one for more, and it's going to give us $24 increase. That's great, but what it also does is it means that the money that we have between the current price of the stock and the strike won't be lost. So we'll actually gain a little bit more in overall potential return, because even though we're getting that extra net, we're giving ourselves an extra dollar for the stock to run up a little bit. So this is the P&L payoff. And this is a good thing to point out here. What we're comparing here is two books. One is a book where we've got stock and this old option that we're currently holding, this 105 call for the 18th, and we're comparing it against the pending book, which is our current stock, with a 106 call for the 25th. Now those are across different expirations. So if we come back to the first expiration, this is the P&L we'd expect. The nice sharp blue line for the current holding for that week, and then this curved yellow line which tells us what our pending book should pay off at the end of this Friday, based on if we were to hold through that. Now, a common challenge in options obviously is, well, we're rolling it out the following week. I'd like to see what to expect. Well, there's a couple ways to handle that. So if we move to that next expiration, you can configure expiration handling in one of three ways. And this will apply to all the options in your book as we walk across expirations. So if you had, let's say there were 10 expirations that you had options for between now and the date you're modeling, this will handle all of those in that same way. Now there's three possibilities. One is cash settle. This simply means that you're going to go out and you're going to close the position with cash. So you're going to buy back your call, and in which case we would still be holding the stock, so we could see the appreciation of the stock, and we could see the change in the value of the call based on the change in the value in the book based on us having bought that call to close at that date. So there's actually an inflection point that's going to happen here. Our modeling tools will go to the 18th for the blue book, go to the 18th, deal with it there, and then have another set of modeling from the 18th to the 25th. And we've got a whole series on how the book manager works that I recommend you check out, to talk about our different price path modeling, the stuff we do between linear and Monte Carlo, the details with modeling the forward volatility skews, and all kinds of stuff. It's really sophisticated, trying to get you the best view of what we have, as well as things like adjustments. Like if you want to adjust it for liquidity costs or the volatility changes that are expected, all that stuff's available, and you can check out how that's done. Now, the second possibility is to say, well, what if I always exercise options if they're in the money, or I let them be assigned if they're in the money? And what that does is the same modeling technique, only what happens here is it hits expiration, right? And then if it's in the money at expiration, it just lets it get exercised, and therefore we don't have the stock at this point. And what you'd actually see is that the value here is going to be slightly better off than if we cash settled, because there is the possibility this goes up and then the stock declines again. For example, that would be good if we use the Monte Carlo views here. I'll turn off the linear. So the Monte Carlo view here is, you'll see this yellow is on this hard line because there's only one scenario model for it, which is between now and this expiration point, because that yellow book only has stock and one option expiring at this date. However, The blue book has two expiration points. It has the 18th, and then it has to model forward. So when you see stuff that's on this line, right, these 2 points are basically saying that it priced, it got here, it got to the 18th using one price, and then it probably dropped. And this one would be, it got to the point where it bought back the option, and it lost money in the option, and then the stock dropped. And so it ended up having this much lower value. And again, I can't really do it justice here in a brief time. I recommend going and checking out the details we have over on our modeling playlist, because that's going to make a lot more sense. But cutting away from this, I like this trade here. The other thing it does is it kind of gives us a slightly better, it moves our delta down a little bit. It looks like the market has kind of moved a little bit more, and we're a little further out. I'm not going to try to play it too much. Right now we'll keep what this gives us. Take a look at our track changes, and this is what helps us a bit. And one of the questions that came up was a little bit more about the trading and rolling. So with this 105 call, we know we need to buy this back because we're currently short, and we want to replace it with this sale. And generally when you do this, you want to try to do those in one transaction, because that'll make it easier for you, because you'll have less risk. You'll know you go exactly from one position to another position, instead of buying this back with one trade and then selling it off with another. Now, if you are with a commission-based structure, if you're paying for commissions, then you definitely want to do this, because there's almost always cheaper to do it as one transaction, multi-leg, than it would be to do two separate transaction trades. In our case, we're not paying commission, so we really don't care. We could actually make these trades multiple times a day, and it wouldn't impact us, because we're paying negligible fees here. But I'm going to click trade. Now we're going to roll that position over. We can see the net credit's at 27 cents right now. I'm just going to see if we can, I'll see if we can fill. Maybe we'll try to notch it up 1 extra cent. We'll see if we can't get that out of it. We'll preview it for that. We'll submit the order. You'll notice it's a $28 change. So we're going to receive $28 if we close at this point for 100 shares, or 100 shares worth of control at 28 cents a share. And then we'll just notch it down a little bit to see if we can change our order to get it filled. And usually we should have pretty good success in filling it relatively quickly, because Microsoft's super liquid, and we're not trying to do anything too egregious here. But I'll bring it down. I'll give an extra cent to the market maker here, just to help us get that closed faster. So we'll leave that for a moment here. Let's take a look at the portfolio. Like I said, we had a bit of movement in the Greeks here. Yeah, we see we're down to negative 25 for our beta weighted delta. Now, that happened probably because the value of our portfolio edged up a little bit. And then as it edged up, you'll notice that big change right there as soon as I said it. That's because we just completed the trade. And so that impacted us a little bit, because we are now, the value that we're holding in our portfolio changed, because we effectively locked in a gain that we had on that other option. And so it moved down. I mean, the net is, it's not bad. I know it can be confusing when you see it go from 250 down to 350 down, but we're in good shape. Our trade filled. We can see our portfolio is updated here, and it's going to bounce around a little bit. I'm kind of surprised. I don't know why this number's so high. It must be the pricing as we get towards the end of day starting to loosen up a little bit. But we did get closer to our negative 15, closer to zero, I guess is the point. I'm going to kind of sum up here. If you have any questions, please go ahead and hit us up at hello@quantcha.com. Or if you have anything you want to share on the video itself, go ahead and leave us a comment. And as always, good luck and good hunting.